Welcome to this week's Real Estate Q&A, where I discuss 5 comments from the past week from our YouTube channel that were posted by our amazing audience, as well as I discuss important issues that could impact the housing market. So this week, we're going to discuss whether it's unconstitutional to ban big corporations from scarfing up all of the single-family housing in America. For many years, institutional investors have been purchasing single-family houses to profit from rental income across America. And corporations like those backed by private equity groups such as Blackstone and Pretium Partners have purchased tens of thousands of homes. And this has been happening in great scale since the great financial crisis, which began in 2008. It's said that more than 700,000 single-family rentals in America are owned by institutional investors, and many believe these corporate buyers have an unfair advantage with their access to cash, offering sellers favorable closing terms with literally no strings attached. And institutional buyers may very well be a major factor that has kept home prices so high like they have been over the last several of years. And that's at least in many of the U.S. states where the majority of home sales were from institutional buyers. And many feel that these cash-rich corporations are bidding against home buyers that wish to own their own home. And this is causing many Americans to be sidelined on achieving the once American dream of homeownership. And now that home prices are unaffordable for many Americans, lawmakers are creating bills to attack these corporate giants. But many believe that their efforts go directly against capitalism and that these laws won't be passed. Hey, welcome back. And if this is your first time to our channel, I'm Todd Sachs. I am a Maryland real estate broker, and I've been serving the housing market since 1989. So to contextualize today's video, first we have to look at how these institutional buyers whet their appetite for investing in single-family homes in the first place. So this all started during the great financial crisis that affected millions of homeowners from 2007 to 2016. According to real estate data company Realty Track, there were more than 6.3 million completed foreclosures in the United States. Despite the actual recovery, which started somewhere around 2013 due to many of the bank failures and a lot of the banks just picking up the pieces from the failed banks, it took many years for some of these defaulting homeowners to actually lose their home. Neighborhoods were showing signs of distress. We had tall grass, boarded up windows and doors, and homes were being rummaged. Appliances were removed, copper piping stripped away from some of the houses. It was really bad in some areas. And in 2009, after Barack Obama was inaugurated as president of the United States, the worst financial crisis post-World War II was literally dumped in his lap. And as an attempt to clean up the neighborhoods plagued with empty, distressed housing, about 200,000 homes were bundled up and auctioned off to private equity firms. The deal was that these corporations were required to actually invest in the distressed homes, bring them up to quality living standards, and then rent them for at least 12 months to people that lost their homes to foreclosure. So to reiterate, prior to 2010, institutional investors were not, I repeat, not in the business of buying single-family homes, only large multifamily apartment buildings and commercial real estate. And quite frankly, this is where many home buyers want them to stay. So now let's take a look at how corporate greed buying single-family homes has escalated in the last several years. Then we'll take a look at bills the Democrats have placed before Congress and the Senate. So let's take a look at this article that is on HUDuser.gov. Now, I just want to let you know this is actually from the Office of Policy Development and Research, and it talks about institutional investors in the single-family market. An estimated 39% of the rental housing units in the United States are single-family dwellings because larger households tend to prefer the size of single-family homes. Roughly 41% of the renter population lives in single-family homes. And between 2011 and 2017, these investors, the institutional investors, like I said, purchased more than 200,000 single-family homes at a total cost of $36 billion. Now, investor purchases surged again during the COVID-19 pandemic, and in the first quarter of 2022, investors' purchase of single-family homes averaged 28% a month. Now, guys, this is the total percentage of sales. So 28% on average of the sales were to these institutional investors. So that's a lot of houses, right? So if you think of 100 houses, 28 of those 100, the home owners were outbid in a lot of cases, and these institutional investors came in and bought it. And what I'm talking about were these home buyers couldn't compete, right? And they paid cash. They gave sellers, in some cases, months and months of free rent. They basically didn't do any inspections, or they did inspections, but they didn't, in a lot of cases, require any repairs. So these sellers were pretty much scot-free and making the top price that they could possibly get. So we compared the 28% per month to the 19% the previous year, and the average of 16% between 2017 and 2019. So now, before we say, okay, we definitely see over the years the percentage of institutional buyers increased, but check this out. 67% of the buyers or the home sales, single-family home sales in Lincoln County, Mississippi were investors. 63% in Van Buren County, Iowa, investors, and 52% in Tarrant County, Texas. And this is all in 2021. So you can see some of these cities, they really went wild in the Sun Belt states too. But, we can see it really became a problem. And, this is research by MetLife Investment Management. They suggest that as of August of 2022, institutions owned approximately 700,000 single-family rental homes. And speaking of MetLife, there was a CNBC article that was posted on the internet earlier this year, and that said that, and this is MetLife, institutional investors do not yet control a large market share in housing, but analysts writing at MetLife Investment Management suggested they certainly could by 2030. I think they were predicting that by 2030, like 40% of the single family homes would be owned by institutional investors. I'm not sure what your take is on this, but now there are bills being presented to Congress and Senate. One bill that wants to prevent completely institutional investors, these private equity firms, from buying single family homes at all. Hedge funds, they want to ban it completely. And for the ones, that already own these single family houses, they, 10,000, 100,000, whatever, hundreds of thousands of homes, they want to give these companies 10 years to liquidate their housing, get completely out of it, or they'll face some pretty steep penalties. The other bill that's on the table is kind of crazy. It's called the American Neighborhoods Protection Act. And what they want to do is they want to require corporate owners who own 75 single-family homes or more, they want them to pay an annual fee of $10,000 per home into a housing trust fund that can be used as a down payment assistance program for families. So, when we look at these bills, one, it's going to require corporations to sell off, one that's going to say it's okay, but we want you to pay $10,000 a year per house. The problem is, guys, is that these costs, if we do the $10,000 fee per house, renters are going to end up paying that. So they're just going to raise rents. If they're crippling the rental market now, making people pay more than they ever have for shelter inflation, 6.5% is what the latest CPI for shelter inflation was released for November. That means that it's still up 6.5% year over year. So where it was in the same period in November of 22. So we're still seeing, though rents are coming down ever so slightly nationwide, we're still seeing that rental prices are at all-time highs. So I don't really think that charging them an extra $10,000 a year is going to help the renters. I also, don't know that they're going to be able to get this through. These lawmakers, they're not confident, many of them in the Senate and the Congress and politicians, they don't think that these laws, these bills are going to get approved because it goes against capitalism or the Constitution of the United States. Now, I do want to say before we get to the questions and comments, please, before you exit this video, if you could drop your comments below as to whether you think that government control should ban institutional investors from owning or buying single-family homes for rental, or do you believe that maybe this is reaching too far, that we don't need more governmental controls? And do you think that by banning these corporations from actually buying our residential housing, that this prevents a capitalistic society? Some question whether we even have that now at all. Anyway, but I would like you to post your comments below if you would be so kind. Just let me know how you feel on this issue. And certainly if you're a homeowner that's been sidelined, you're probably going to be a little bit more passionate than someone that's lived in their house for 30 years. But I want to read them all. But anyway, so let's go ahead and jump into this week's questions and comments. All right, so our first commenter here, this is actually from this week's Tuesday Night Podcast. They said that the right way to fight investor owning homes is to take away the financial profitability, triple the property tax on single family houses to 3%, and make homestead tax low like 0.7%. When the deal does not pencil, those investors will get out. Homes are for living, not for investing. Now, let's kind of play this out because, again, as I just mentioned, I think that any kind of costs that are imposed to corporations that own rental real estate, I think ultimately they're going to get passed down to the tenant, like any other cost. But in theory, they do charge these investors already more than homeowners that are protected by homestead credits. And what a homestead credit is, when you buy a house and it's your primary residence, what happens is you are capped on the amount of tax increases, the phase-in value, though it may go up, a lot higher over the next several years. You're capped on what the government can charge you if you live there as your primary residence under this homestead credit. So it can only go up so much a year. It phases in. Now, it still does go up. When the property is not your primary residence, whether you're a big corporation or a mom and pop landlord, you don't have any sort of phase-in value at all. If they come through, reassess all of the properties, which they have been doing, since the home prices have been going up, they want their money. What happens is you have no homestead protection when it's not your primary residence. So a lot of people do, they do commit fraud, with saying that they live there. They get, 30-year fixed rate mortgages. There's a lot of mortgage fraud that, I've heard lenders talk about, to where, they're getting a 30-year fixed rate mortgage, but they're not actually living there. And that is bank fraud when you're filling out the application without the intent of making your primary residence. So these areas become, a little more gray and a little more difficult to, regulate the property tax bill for whether somebody's living there or somebody's not living there. But again, I think what this commenter is saying is that, hey, something needs to be done. So our next comment says, would someone consider allowing low interest mortgage rate to be transferred to the new buyer? Now, this comes up a lot. I actually get this question quite a bit. People are wanting to buy a house and they say, hey, if this guy's selling, what is his mortgage rate? And can I assume his loan? The short answer is yes. You can assume mortgages. There are assumable mortgages. Here's where the problem comes in. Most of the buyers, at least a lot of the ones, on the sidelines today, these first-time buyers, they don't have a whole lot of cash. In order to assume somebody's mortgage, let's say you're buying a house for $500,000. And let's say there's a $350,000 mortgage at 3%. In order to assume that mortgage, you have to put the difference down in cash. So a lot of people barely have 3%, 3.5%. VA buyers, a lot of them are going in with 0% down. They may have money to put down, but they don't. But let's just say you don't have $150,000 to put down, plus your closing costs and all your escrows moving forward. You then need to get a second mortgage, which is not easy to do, to qualify for that. And those mortgage rates are way higher than if you just got a 30-year fixed rate mortgage right off the start. So preventing people from using this ideal is the fact that they would need to come up with a lot of cash potentially, and it's just not practical. Our next commenter is talking about a video that I did with Peter Schiff. I flew down to Puerto Rico. Peter Schiff is a global strategist. He's also an economist. He was a stockbroker on Wall Street for years. Anyway, he's always on news channels and podcasts, but I had the privilege of meeting him firsthand. I went to his house in Puerto Rico. You can watch the video here on our channel. But anyway, this commenter is saying the last COVID money went out March 12th, 2021. And we're talking about stimulus here. I mention a lot of times, a lot of other people do, about the stimulus money propped up the economy, was one of the reasons that allowed pricing to get out of control, inflation to get up to over 9%. We know that real inflation was more like 20%, 40% on certain products. But anyway, that's a lot of people are blaming the stimulus, and it is true. We printed more money than we ever have. But this commenter is saying, how are we reliant on $600 to $1,400 from almost 3 years ago? And what they're saying is that we keep talking about the stimulus money that has propped up the economy. And this commenter saying, well, I didn't get it. I didn't get very much anyway. And how is that applicable when it was 3 years ago, it was a little bit of money? And is there something that I'm not understanding, as commenters asking, when people cite COVID money? Now, I think what we need to look at here, a couple different things. Number one, everybody was on unemployment. I mean, we hit, double-digit unemployment rates in a matter of weeks, and the country was shut down. The federal government stipend $700 a week for like 7 weeks on top of state unemployment. People were making more money to sit at home than they were at their job, right? So we paid them to stay home. I'm not disputing whether it was a good move or a bad move. It's just the fact. The other thing that we did was we prevented landlords from evicting tenants that didn't pay their bill. So they got stimulus, they had unemployment, but they didn't have to pay their landlord. So a lot of them didn't, and the landlords couldn't do anything about it. The other thing that they did was they prevented mortgage companies from foreclosing on the borrower. They didn't have to pay their mortgage. And there's been so many different, this is really where I want to focus on, and not despite the fact stimulus that went out to the states when the mortgage moratorium was lifted. Here in Maryland, borrowers could get, people defaulting on their mortgages could get $50,000 in money to pay, housing related costs. Not only that, but the loan remodifications, it's just a lot that people don't really realize just how much money was printed and handed out. Now, the ones that saw it the most were the ones that were in default. And you didn't have to really say much as to why you were in default. All you had to say was that it was COVID related. And so a lot of that has ended. It has ended officially in December right now. The last time to apply for 6 months of no mortgage payments was May 31st of 2023. So that ended in November. So now what's happening is FHA is acknowledging that they still have a lot of delinquencies in their mortgages. And now they're coming up with a mortgage payment credit program they're hoping to launch by the end of this year that I think is going to give up to $1,000 a month to defaulting homebuyers with FHA mortgages to help prevent foreclosure yet again, going into 4 years after the pandemic. So, I think when you hear people that are saying, about the bailouts, this is really what they're referring to. It's not just that you got a stimulus check in the mail for $600 or $1,200. It goes much bigger than that, much deeper than that. The largest bailout that we've seen in American history. And in fact, we printed more money in 2 years than we did in 200 years, that is. So anyway, next one here was again from our Tuesday night podcast. Great content about the buy downs. Wow, what a scam. Didn't realize they tack back, like when you turn in a lease with 3 payments, they don't buy it. They tack onto a new lease. What we're talking about here is, and a lot of people don't know this, but our guest this past Tuesday night was a expert in the mortgage industry. Actually has 3 more years of experience in the housing market than me. He started in 1986. I started in 1989 serving the housing industry as a contractor. But Paul Malmstrom, the loan officer I'm talking about, was describing what a 2-1 buy down was all about from what we're hearing a lot of home builders that are, trying to entice buyers right now with higher mortgage rates, trying to entice them into buying a home, that there's a lot of them are saying they'll do a 2-1 buy down. So let's just run through the scenario real quick. You buy a house in this scenario. Let's say today's mortgage rate 7.5%. What the home builder is doing, or any seller can do it, anybody can do it. They're paying down the interest difference, 2 points of interest. So let's just say the first year in what's known as the 2-1 buy down, they're buying 2 points of interest off of your monthly payment. So your interest rate's still 7.5%, fixed 30-year interest rate. But what the builder's doing is coming in and giving you a cash incentive that your first year is only 5.5%. So they absorb what the lender's missing between the 7.5% interest rate and a 5.5% interest rate that first year. They're paying the difference. Then the second year, they're paying the difference of 1 point, 6.5% to 7.5%. They're giving you the lender that money in advance so that the first year you get 2 points off, you're at a 5.5% payment. The second year, you're at a 6.5% payment. And the third year, for the rest of your term, you're back to 7.5%. And what a lot of these builders or mortgage loan officers are saying to buyers is just buy now, because if you don't, you're going to be sorry. Home prices are only going to continue to go up, and you can always refinance later. And we also talked about that in this last live show, because that's not necessarily true. What they should be telling you is that you better be happy with your 7.5% interest rate, because you may not be able to refinance, even if mortgage interest rates drop. It may not make sense for you to do it. You're going to spend money to refinance. Could cost you $7,000, $10,000 just in loan origination again, right? You start your amortization schedule back to zero again, meaning most of your payments are interest only. And not only that, you have to reappraise your house. And if the housing market continues to decline as far as pricing, you're going to need to bring more cash to the table, because they're not going to give you the same amount necessarily in your refinance. So before you jump at any of these enticements, these rate enticements, make sure that you look at all the details and that you really know what you're getting. And our next commenter says, if mortgage rates drop to 5%, sellers will jack up prices because realtors will say, see, rates are coming down and will continue to do so. You can refinance at 3%, just like I said, in a few years, and buyers will be dumb enough to believe them. Now, guys, I have a theory, and I'm not saying that I'm right, but this is a theory that I have about the current situation with the housing market. Because a lot of people want to say that there's the lack of inventory, the supply and demand. Right now, we're seeing home builders have been giving rate buy downs. Some of them are even giving 5.5% fixed mortgage rates over 30 years. These are some of the offers that we've seen, and buyers aren't flooding in to do so. So this tells me that interest rates aren't the only issue that we have here. I think that over the last several years, a lot of the home buyers now have learned from the past mistakes of the last several years of their peers, the remorse, the amount of overpaying that they've done, and not demanding the seller fix things. They live in a house for 20 years, didn't need to fix anything that was broken. People just bought it anyway. And I think that the buyers are more educated now because we can look back in history and learn from it. So I believe that dropping mortgage interest rates is actually going to flood the housing market with inventory that we've been waiting to see. And it wouldn't take but another million homes to hit the market. We see that there's 1.2 to 1.3 million of new home construction starts that have started nationwide. We know that there's 7.8 months supply of new homes right now active on the market, which is well into a buyer's market, anything more than 6 months. And we're really looking at a situation where I think the buyer's affordability is tapped out. So I think by dropping interest rates at this point, they may as well just keep them where they are. Because if they drop the interest rates at this point, sellers are going to be like with the golden handcuffs, hey, I finally have a chance to break free. I'm going to sell and hope that I can get top price, as well as a lot of these rentals, short-term and long-term rentals, where people, again, they're just waiting to get out also. So by flooding the market with inventory is going to outpace the buyer demand, because buyers, like I said, it's not the demand that you think it is. People are in debt. They're in credit card debt. They're in auto loan debt. They're, already signed with new leases and well into 2024. They gave up. So a lot of these buyers are cooled off. I don't think it's the demand that the sellers are hoping for. But anyway, time will tell. Again, drop your comments below, guys. I appreciate you. I love our audience. You guys are the best. If you like the video, you can let me know you did by smashing that thumbs up. If you haven't subscribed, oh, what are you waiting for? Let's go ahead and do it now and hit the alert bell, every time we publish content just like this. And lastly, the biggest compliment that you can do for me here at Sachs Realty, share this video with one of your family members or your friends that you feel needs to stay closer in touch to everything real estate. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.